Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Here's what we're watching this hour. First up, how far can the tech trade run? We'll discuss with Dan Ives of Wedbush. Plus, big banks gear up for earnings. We'll preview what to watch. And we sit down with the incoming CEO of Plug Power to discuss the state of the business, its stock rally, and more. First up, let's take a look at what's going on in stocks here today. Right now, we've got the Dow trading higher by about 157 points, about a third of 1%. The S&P 500 up about a quarter of 1%, and the Nasdaq up about a third of 1%. Just going back to the S&P for a moment, since it's a Friday, taking a look back at the week that we have seen, it looks like there's potential for the S&P to close at another record today. I believe the Nasdaq's on track for the same, so we'll take a look at it as we go throughout the session. And it has been an up week, but an up week with a lot of ups and downs in a relatively tight range. So that's something we'll continue to watch. We'll also continue to watch what economic data we're getting. And speaking of which, we just got preliminary October consumer confidence from the University of Michigan. It did fall to 55, but that's better than the estimate of 54. It's still the weakest reading since May. So that's something that we're going to be watching and taking into account as we watch trading across the board, particularly in the bond market, where we've seen, again, kind of a sideways move-ish over the last week. 4.1% is where we see the 10-year. So a little bit of buying is what we've seen there in the bond market. And getting more into what's going on in stocks here today, taking a look at the NASDAQ 100, pretty mixed here on the day. But again, looking at the 5-day look, still see a mixed picture here. A lot of big up movers on the week, or relatively big up movers. NVIDIA up 3.4% on the week, but we see Alphabet and Apple down. So as we've seen these fits and starts in the AI trade, overall, we still see a lot of upward momentum with some exceptions here that we continue to track. Let's look at one stock in particular now. It's Plug Power. Plug Power shares have been pretty volatile this year. The Trump administration's cuts to clean energy projects weighing on the stock earlier in the year, but shares have exploded since then. They're up over 200% in the last 6 months. Joining now for the future, to talk about the future of the company, Jose Luis Crespo. He'll be Plug Power's new CEO starting in March of next year. He's currently President and Chief Revenue Officer. Jose, congrats on the move, and thanks so much for joining us.
Thank you so much, Julie. I appreciate you having me on the program.
Thank you. So Andy Marsh, who has been the CEO for, something like 17 years at the company. So obviously, this is a big job you're stepping into. How do you think about carrying on the work that he's built, but now pushing Plug Power into the next phase? What are some of your priorities?
So I've worked in Plug as well for about 12 years, and I've worked with Andy very closely as the lead for sales for the company. We put plans together to get the company to the financial results that we want to get to. I participated in those plans very closely. So my priority is to continue executing on those plans. We've seen in the last few quarters how Plug has been seeing those results. We have improved our gross margins. We have reduced our cash burn. We have plans to get to gross margin neutral by the end of this year, and EBITDA positive in 2026. And that's going to be 100% my priority, to continue in that path and get to profitability.
And talk to people who are watching a little bit more about how you get there, right? What are the steps that you all still need to take to get to that gross margin, not just the break even, but then the positive gross margin going into next year?
Right. We've done a lot of things already, and we're executing on those things. We put together a project called Project Quantum Leap, in which we did some reductions in force. We work on cost reductions for the products. We also increase pricing for customers, which it was a tough thing to do, but we did it, and our partners, especially our largest customers, supported us on this. So some of those things are beginning to bear fruit now. The other thing that we need to get to profitability is sales. We need to increase sales, and this is why the board of directors and Andy decided to give me the trust to run the company, because the main thing that we need to do right now is to to increase our sales. We have built a very healthy $8 billion funnel. My job is going to be to make sure that we capture as much of that funnel so we can increase our top line to get to profitability.
And Jose, for people who are not that familiar with Plug Power, just quickly here, what you guys are selling. You have three segments: hydrogen generation, electrolyzers, which effectively make hydrogen or separate hydrogen in water, and material handling, which is fuel cells for things like forklifts. Where is that sales push going to be?
The sales push is going to be mainly in the material handling side and the electrolyzer side. As you mentioned before, at the beginning of the year, there were some concerns about, the new administration. But after the bill was passed in July, it was clear that for material handling, we still have the investment tax credit, which provides a 30% tax credit to the customers that buy our products. Our largest customers buy those products: Walmart, Amazon, Home Depot. So that is really going to help increasing the sales in the next few months for material handling. And then on the other side, the PTC was also extended or actually changed to up to 2027. So if you start your projects before the end of 2027, you can get the production tax credit. We can give you up to $3 per kilo if you produce green hydrogen. So those things are really going to help also increase our sales in the electrolyzer side. In the European market, we still see a strong commitment for sustainability and for green technologies. And we are seeing that the directives of the European Union are beginning to become by transposition laws in the different country members. One of them that just did that was Spain, which has a very, very healthy renewables market. And we're seeing a lot of activity in that market as well related to electrolyzer business. So we're going to see electrolyzers and material handling really, get into growth. And then in the case of hydrogen production, the majority of the hydrogen production that we do is for consumption for our own customers. Our customers consume hydrogen. So we're going to see that is going to help us with profitability because our own production has healthier margins than hydrogen from third parties. So that's
yeah, Jose, I wanted to ask you more specifically about the U.S. Even though some of these changes have not been as bad as feared, there is still sort of a seeming animosity on the part of the administration toward anything renewable energy. That's a very big bucket, obviously, but can include hydrogen. How concerned are you still, and can you give us any update on that outstanding Department of Energy loan that there were some questions about?
So hydrogen is something that we use already for many industrial processes. Just as an example, refineries use hydrogen. So hydrogen has always been really a bipartisan matter. And we have gotten, in different administrations over the past years, support from both sides of the aisle, right? So we see that still, and we hope that even, and actually with the change on the PTC to be active until the end of 2027, we see good opportunities there. Regarding the DOE loan, we keep on talking to the DOE department. Not at this moment, given the government shutdown, but up to the shutdown, we've been talking to them. We're trying to work through the process, and we hope that things will move along.
And Jose, finally, I wanted to ask you, some have considered Plug Power a bit of a meme stock in the sense that retail investors have gotten more interested. We've seen that big move in the shares, which can sometimes characterize that sort of meminess or retail interest. And I'm just curious, as you step into the CEO role, do you have any plans to sort of engage more directly with the retail investor community as you make that transition?
I have plans to engage with all investors, and the retail investors have always been very important for Plug. So yes, we really take them, very seriously and value their feedback and their trust on the company. So all investors are really important for Plug, and they will continue to be for me.
Jose, thanks so much for your time. I appreciate it. No,
thank you, Julie. I appreciate it.
Coming up, big bank earnings are on deck. What to watch as the results roll in next week. That's next on Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. First up, we have Baidu. That stock was raised to outperform this morning, up from neutral over at Macquarie. The analyst there also raised his price target to $176. That's up from $91. The analyst cited that the company diversified the revenue stream with both cloud and artificial intelligence chips. That alongside the potential of robo-taxis. There are currently 27 buys, 11 holds, and 0 sell ratings on the street. Next up, we have Pony AI. Jefferies initiated coverage on the stock with a buy rating. The analyst said the Chinese robo-taxi market is transitioning from a pilot to scale, and that Pony AI is expected to stand out for its regulatory leadership, cost-down roadmap, and full-stack capabilities. The stock currently has 13 buys, 0 holds, and 0 sell ratings on the street. And finally, Synchrony Financial. HSBC upgraded the stock from hold to buy with a raised price target of $81. Right now, the stock is at $71. The analyst cited its recent stock underperformance, down around 4% in the last month, as a buying opportunity. The firm also expects Synchrony's credit quality to remain resilient and for its loan and revenue momentum to improve next year. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now, time for some of today's trending tickers. We are watching sports betting companies, Venture Global and Mosaic. First up, let's look at those sports betting companies. They're taking a little bit of a hit today. The New York Times Dealbook has reported that their rival Kalshi will announce fresh funding. The prediction market platform is said to have raised more than $300 million. It's also reportedly opening up to international bettors. The new funding would give the company a $5 billion valuation. Backers include Sequoia and Andreessen Horowitz. As you see, DraftKings, MGM, Flutter all under a bit of pressure. Next up, Venture Global. Shares sliding after the LNG company lost a dispute with BP. That's liquefied natural gas, by the way. BP alleged the company had violated its long-term supply contract. They say the violation was in order to make bigger profits on the spot market. Essentially, the problem was BP and other companies had long-term contracts, but they weren't getting any deliveries. The development delivers a blow to Venture Global, which has become one of the largest exporters of LNG in the United States. And by the way, if you recall, this company went public this year. It was one of the first back in January at $25 a share. And as you can see, it is now trading just over 10, down 18% today alone. Finally, we have Mosaic, the fertilizer company, saying that plant interruptions hit its phosphate production. Third quarter phosphate production fell below what management had expected. That's due to mechanical issues at one plant and utility interruptions at another. Preliminary sales volumes for phosphates also fell short of what analysts had predicted, those shares down 8%. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, big banks are set to report third quarter earnings in the coming days. Analysts expecting strong results, boosted by a rebound in investment banking. Joining me now, Chris Whalen, Whalen Global Advisors Chairman, longtime watcher of the financial industry. Good to see you, Chris.
I see you, Julie.
So, what are the big themes you're going to be watching for? Trading profits, great. Rates going down, double-edged sword.
Right.
But what's going to be sort of the driving force this quarter?
I think like last year in the third quarter, when we had a little bit of a rate rally, we're hoping that rates are going to slowly fall enough to get volumes up. Because what's interesting is we've been talking about eventually the Fed cutting rates. The industry has been cutting rates for several quarters. They've been pushing rates down, partly because there's not much demand, partly because it's very competitive. There aren't a lot of big assets out there. So all the banks, the non-banks, the funds, everybody is competing for the same dollar of assets. The retail side, mortgage lending, they were all front running the rate cut by the Fed, a few weeks ago. So they pushed rates almost down to 6% for 30-year fixed rate mortgages. They backed up a little. But remember, lenders put coupons on loans, not markets. Markets are about when you sell a loan to an investor. So if the lenders want to get aggressive and get ahead of things, they can push coupons down. And you've seen that. A lot of banks have been very aggressive.
So in other words, like we're seeing really across the economy here, effectively cutting prices, or in this case, cutting
That's right.
rates to bring in those volumes. So maybe sacrificing a little margin to get those sales in the, to get that lending volumes in the door.
And get that customer and hopefully keep that customer. Whether it's a business customer or a consumer, doesn't matter. Because all of these big banks, whether you're talking about JP Morgan or Rocket Mortgage, they're little cities with moats around them. And they're trying to protect the portfolio of customers that they have, get some new ones if they can, but really it's about the network effect. No matter which industry you're looking at, Julie, it's about your network. Can you defend it? Can you grow it? So if you look at a JP Morgan, they're easily the price leader in the market because their costs are so low. The other banks have been forced to essentially accommodate that. How do you get growth in this industry? You go out and buy another bank.
Right.
So we saw Fifth Third buying Comerica, which is not a transaction I like, by the way.
Well, I want to get into that in a minute, but first, just to linger on the earnings for a second, we have seen a revival in IPOs over the last couple of months. Is that something that's going to show up yet in the earnings for the banks this quarter? Are we going to see that kind of IPO or M&A revival, show up in the IB numbers?
All of the above. Capital markets has done well. Look at Goldman. That's one of your weather vanes. Jefferies is another one you want to look at because they're in a slightly different calendar year. So you get a look at Jefferies before you get a look at everybody else. But the bottom line is the market side of the house is going to do well. It's going to make up for the lack of activity on the bank side of the house. And the other big issue for the banks, I think, is concentration risk. What has been growing in the past couple of years? Loans to funds, loans to non-bank financial companies. So that's the big worry you hear from people in Washington. So far, credit is okay. If anything, the banks have been giving back money instead of building reserves. And remember, we're going to buy back a lot of stock this year. Records, in fact.
Let's dig into the private credit thing for just a second here, because for people who are watching and don't understand quite how it works, basically you've had this ballooning of the private credit industry. Non-bank companies lending out money to all kinds of different businesses.
Right.
But the banks lend those private credit company or invest in some of those private credit companies in turn. So they do have that exposure. There was just a company that went belly up that was an auto parts
First
company.
Brands.
That was very exposed in private credit, or private credit lenders were exposed there. Does that give us any kind of a taste of things to come, or do you think that is a rarity?
No, I think it is because the terms on these transactions have become so competitive that a lot of the protections that investors used to have aren't there anymore. So for example, there was no trustee for the debt of First Brands. There was no one watching their paper. They were double pledging the same accounts receivable paper to multiple investors. Remember Bear Stearns during the great financial crisis, multiple pledges of mortgages? This is the same thing. So I think the street is unfortunately paying the price for being so aggressive on the terms on these deals. Read the earnings call from Goldman Sachs, where they talk about taking losses on their own private equity portfolio, which is the same stuff they've been selling to their customers. So the street is conflicted in multiple ways here, and I think as we unwind it and we see the losses that some of the big universities and pensions and endowments are taking on private equity, that whole sector I think is going to cool off. But why were we doing this? Because there was no other activity out there. The banks went where the volumes were.
Right.
And again, we didn't have stuff to sell to the retail clients, the high net worth, the institutional. So we created some new paper.
Well, hey, we've seen this movie before.
Yes, we have.
You and I know it very well from the financial crisis, but it doesn't feel as systemic or as alarming as it did back then.
Because it's private. Behind the veil.
Is it just because we don't know enough about it? Is it as alarming and we just don't know?
It's like commercial real estate. It's not a front page kind of story, so it's not going to grab people. What is going to grab people are things like the home builders, which have been selling off dramatically. Why? They have too much inventory, which they have been building by being very aggressive. They weren't discounting the houses. You know what they did? They were buying down the loans. So they would go to a consumer who couldn't afford a 7% mortgage, and they would subsidize 2 points of it and give them a 5%. Yep. So what's the probability of default on that subsidized mortgage? It's higher than somebody who could pay 7%.
All right, so a lot of things to watch going forward. And
well, credit is the story of the future. Let's put it that way.
Okay, so we'll keep talking about that, but I do want to get back to the consolidation story also. Fifth Third, Comerica. As you said, you were not a fan of that deal happening.
No.
Why not?
Fifth Third is a well-run regional bank based in Cincinnati. not known for aggressive M&A. I just don't know why they're doing this deal with Comerica. Comerica had moved from Detroit down to Texas years ago. They got badly beat up in 2023 when Silicon Valley Bank failed. So the bank has shrunk about 15% since then. They didn't cut their overhead. So the first thing that Fifth Third is going to have to do is take the chainsaw. They could borrow it from Elon Musk and go down to Dallas and really severely cut the costs on that part of the business. For me, all of the banks have the same problem. They feel like they have to get bigger. How do you get bigger? You go buy another bank. But many of these banks have done multiple acquisitions, so they end up with lots of goodwill, sometimes overhead that's not that attractive. There's a 12-point difference between Fifth Third and Comerica in terms of operating leverage. So they're going to have to fix that. I think, to me, you're going to see more deals like this, but they may not be that great because, again, if you look at the balance sheet, look at how much goodwill, look at the losses. One of the things that really struck me about Comerica is they're not doing a good job on their bond portfolio. The yield on their bond portfolio is in the twos.
Which is interesting because you would have thought if they got hit in 2023, they might have.
Well, yes and no, but you have to have the income. I'll give you two great examples. Truist, PNC, a couple quarters ago, they started restructuring some of their low coupon securities from the COVID years, and all of a sudden their net interest margin jumped. So the banks that have the income are being aggressive about fixing their balance sheet, but then you look at Bank of America, Brian is waiting for, the Fed to come to his rescue because he has a huge book, and his book is well below the peer group in terms of returns. So I think there's a lot of people are hoping that the Fed is going to pull up volumes, fix balance sheet problems, and maybe drive some M&A. But I don't know, banks are pretty well valued right now.
Gotcha. Just real quickly, who do you think is going to be the big bank winner of the earnings season?
Watch Citi. They're doing good things. They're still trading below book, but it's the best performer of the top five. Goldman is going to do very well, I think, looking at last quarter. The real issue is, are we going to get surprises?
Right.
Are we going to hear more losses on the private equity and commercial real estate side? Yes. But overall, I think the banks are still a snoozer. They're really not, on the consumer side at least, there's not a lot of pain. And the commercial pain, you don't see it. It's behind the screen. That's professionals and lawyers are dealing with that.
Interesting. Chris, good to see you. Thanks
nice
for coming
to see you.
in. Appreciate it. Coming up, what to watch in third quarter tech earnings and the next phase of artificial intelligence adoption. We'll be right back.
Earth imaging and data company Planet is taking satellite imaging to the next level. Company announcing plans to launch a new Owl constellation capable of delivering AI-analyzed images within an hour. And they're powered by NVIDIA chips. For more, we're bringing in now Planet co-founder and CEO Will Marshall. Will, it is good to see you. So let's start with this news. You're launching this constellation of satellites, Will, called Owl. Help us understand, Will, what these satellites do, what's special about them, and what do you think the competitive advantage you have is in the market with these satellites?
Well, great question. So at Planet, we have the largest Earth imaging satellite fleet ever in human history. And we use AI on top of that to do processing. And that enables us to answer questions about the planet for all sorts of customers around the world. And we have the most data of any satellite company. And that is really useful for training AI on what's going on around the planet. What we're doing with Owl is a totally new and unprecedented capability. We are going to be scanning the whole Earth landmass every day at 1 meter resolution, so much higher, finer detail, and get the data back within 1 hour with that processing on the edge that you mentioned, the NVIDIA processor chips on board, so that we can do AI processing upstairs. That means do those image processing and send down the location of ships, or help us to do disaster response after a flood or an earthquake or a fire really fast to help real people on the ground.
So if Owl, Will, promises this sort of higher resolution, AI analyzed images all within an hour, I'm curious, what are the kinds of companies, Will, what are the kinds of sectors that you think would be most interested in this data? Is it energy, Will? Is it agriculture? Is it defense?
I think the particular kind of use cases that come to my mind are those that involve things like disaster response, where they need quick timeliness. So imagine after a fire, how do you get data on where is which buildings are affected? How do we get that as quickly as possible to the first responders so they can get there on time? Or security, where if there's events, you want to know as quickly as possible if there's a new threat around the corner, on the horizon. And so it's those kind of applications. And this is why, by the way, we call them owls, because they are smarter and they're sharper. So they've got big eyes, they're wise. That's why we call them owls.
Does OWL replace your existing satellites, Will, or no, you think of OWL as supplementing them?
It's an upgrade. So it will actually be backwards compatible with our present fleet, but it will be just enhanced resolution and faster timeline.
So you have these space services deals, Will, whereas I understand it, correct me if I'm wrong, you might have a customer like Japan and you'll build and service satellites for Japan, but when the satellites aren't over Japan, you'll sell that excess capacity to other customers, which sounds potentially pretty lucrative. Will OWL be used for that as well?
You understood it perfectly well. So the partnerships that we did with Japan and now in collaboration with Germany are enabling us to build, launch, and operate satellites for countries that want dedicated satellites in their area. But then, as you say, so the Japan deal is just over $200 million, the same with our partnership with Germany for a set of 10 satellites and 7. And what these can do is enable those countries to have dedicated capacity in their area. But what we can then do beyond that is sell the data in the rest of the world. So this is good for us because it helps pay for our capex. It's good for them, they get sovereign eyes, and it's good for the rest of the world, because all the rest of our customers, because they get more capacity, more revisit rates. So and eventually it's possible that our OWL fleet could go into that as well, but that's a non-tasking system. So really, I think the primary use case for sovereign systems is a tasking system to help countries have specific eyes where they need it.
I would imagine, Will, that investing in and building these new satellites, that's going to require some capital. For your investors who are listening right now, Will, how should they think about what this means for your financials, for your bottom line?
Well, a good question. I mean, there is capex, obviously, of building and launching satellites, but let me put it in perspective. All of our satellites combined that we've ever launched, which is over 650 to date, we launch about 4 times a year. We're extremely prolific on building and launching satellites. All 650 have cost less than the single last satellite before Planet started from our competitor. So one satellite, all 650 cost less than one satellite. So we are seeing more than 100x decrease in cost, or increase, as we put it, in cost performance of satellites. That means we're stuffing more capability, more compute, as we said with NVIDIA, more processors, better sensor systems, better radios, and so on, into the smaller package so that we can do more with less.
Finally, Will, you do have competition. You think of names like Maxar, for example. I'm curious what you think makes you all different. What sets you apart, Will? Is it the tech? Is it just the sheer size of the satellite constellation? What is it?
Well, the first thing is the size of the fleet. So we have around 200 satellites in space. That's more than 10 times larger than any other Earth imaging company in the West. Secondly, it's AI, because we're the only ones that do a daily scan of the entire Earth's landmass. No one else does that. And with that, it unlocks huge applications across agriculture, forestry, finance, insurance, sustainability, security. And it opens up the relevance of space to AI, because everyone knows what's going on with the space revolution, cheaper rockets, but then the increased cost performance of satellites has gone up about 100 or 1,000x over the last 10 years. And the upshot of all that is more data. And this is where it merges with AI, because AI is only as good as the training data you train it upon. Now, all these AI models are basically trained on the text of the internet. But just imagine the power of being able to answer questions, not just of the text of the internet, but of the real world. Imagine being able to ask questions about the farmer's field next to your farmer's field. Imagine being able to ask about disaster response. Imagine being able to ask real world questions. The power of that is what the next generation of AI models are going to be able to do in combination with our data set. And Planet is uniquely set up for that opportunity.
Well, great to see you. Great to have you on the show. Thank you.
Likewise. Thanks for having us.
The government shutdown is in its 10th day, keeping hundreds of thousands of federal workers on furlough. At the same time, layoffs in the private sector are creeping higher. So how can you prepare yourself in the event of a similar economic pain point or an emergency expense? Joining me, Edward Smith, Valor Wealth Partners founder and president, for this week's FA Corner, brought to you by Capital Group. Ed, thanks so much for being with us. And you all do serve government employees, so obviously I imagine this is very much front and center on their minds right now. But as they think about not just this situation, but future furloughs or other things that come up, how do people go about kind of making sure they have that emergency savings?
Yes, hi. We do serve mostly federal employees. One of the things that we look at is making sure that they're getting in control of their expenses, and then they can start looking at how they can save. In these situations, it's very important to look at the cutting back, but then when you look at the savings, it's looking at how your savings, maybe cutting back on your TSP, or other discretionary things that you're doing, so you can build up those reserves and be comfortable when this happens, or more importantly, the fear of this happening, because we see more and more the fear of this happening, even if it doesn't happen. The last one was 2018. That was really big, but we've had a lot of times in between where people have been very much worried that they're not going to have a paycheck. So
when you're counseling people on this, how much do people need to think about setting aside, either as a percentage or, flat amounts when they're trying to think about building this up?
We actually look at it in three different ways. We look at it in an emergency reserve, which is the emergency cash. And that's more like your credit cards or something that you can get to really quick, like if you have to jump on a plane, pay for a car breakdown or something like that. Cash itself should really only be about 1 to 3 months of expenses. And then beyond that, we want to be looking at maybe about 6 to 8 months of what we like to call catastrophic reserves. And they can be maybe in a higher yield savings account, maybe in an investment account that's not too risky, but you have plenty of reserves. This would go into that catastrophic category where you want to reduce those risks at this period of time. But so generally, you're looking at somewhere between maybe 9 months to 12 months of overall reserves, but it doesn't always have to be in cash because it's not earning any money in that period of time.
And, I think people want to be able to reach for a liquid instrument that they have that they have at hand. But I guess loans are also a potential, effectively that's what you're getting when you use your credit card as well. But, sort of bank loans and more traditional loans, is that also something that people need to think about in emergencies?
Yes, this is a very unique emergency, and we've actually heard of some agencies that are offering 0% for a period of time. Like we know one that says 0% for 60 days. They are an agency credit union, so they're offering a very specific loan to employees or federal employees for this situation. To prepare, you want to have good home equity lines of credit. So if you own a home and you have equity, always having that on hand is always a really good catastrophic reserve if you can't save. And then when you're in this situation, while we don't normally like them, the TSP loan is a way to be able to get money, or a 401k is a way to get money out of your 401k and be able to pay those bills. Because at the end of the day, if you aren't putting food on the table, if you aren't being able to pay for your bills, or you're hurting your credit, this can be very bad. What is worse? And so I would say getting some of those loans is something that's very viable for you.
And as you say, you have to prioritize. So, in the case of pulling money out of a retirement account, sometimes you get there's a penalty for doing so, but you see it as a worthy trade-off in some situations.
Well, the loan is different than actually pulling the money out of the retirement account. And so a loan is a short-term borrowing. Now, there is some legislation that's being passed to possibly be able to take money out for contractors, not necessarily federal employees, in this type of situation in the future. If it passes, we don't know. But yes, we don't want to do that because you could have taxes at a high level, and you could also have a situation where you're actually paying a 10% penalty for early withdrawal if you're under the age of 59 and a half.
And then, Ed, finally, just quickly, what are you hearing from your clients right now? Are they, distressed, or have they kind of built up these plans so they're doing okay?
Most of our clients, we've actually been working to make sure that they've had emergency reserves over years. So when we get to this situation, sort of like a market crash, they're prepared for these. They know what to do. They know we have a plan, and the communication with them is very important. If you're left on an island all by yourself and you don't have support, you're dealing with these burdens, and emotional and behavioral burdens are very tough. Getting through this on top of when am I going back to work, but how am I going to pay the bills? And if you're doing all that all by yourself or with your spouse, that can be very bad. So leaning on an advisor is something that's very critical, at least in our opinion.
Ed, thank you so much. Appreciate it.
Thank you, Julie.
That was FA Corner, brought to you by Capital Group. Coming up, we have full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, stocks set to close out the week. Well, they were set to close out with gains, but not so fast. But we'll talk about the bull market run overall. Plus, labor market and inflation concerns weighing on consumer sentiment. We'll have more on that ahead. And we'll hone in on the state of the energy transition with Rich Lesser, Boston Consulting Group Global Chair. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check on the markets. And I said not so fast because we were higher. And now we are not. Stocks quickly taking a turn for the worse here, with the Dow now falling by 230 points or so. The S&P 500 off more than a 0.5%. The Nasdaq off 0.4%. It might have to do with a post on Truth Social that the president just posted a few moments ago. It's quite long, but summing up, criticizing China here. He says some very strange things are happening in China. They are becoming very hostile. He's talking about the export controls that they want to impose on rare earths and talking about some other elements here. But it seems like that is something that may be affecting the markets at the moment. We will keep on it and keep you posted on any developments. Well, meantime, markets have traded at records throughout 2025, with the Nasdaq notching a fresh intraday high today before it turned negative. This has all sparked concerns of a potential AI tech bubble. My next guest sees some similarities between what happened in 1999 and the current rally. I want to bring in Jurrien Timmer, Fidelity Investments Director of Global Macro. Jurrien, it is always a pleasure to get some time with you, so we appreciate it. I do want to get to the 99 parallels, but before I do, the markets seem to kind of have forgotten about the U.S.-China trade deal and that there may be some potential rockiness between now and getting a deal done. Do you think that that's a mistake? Do you think it's something to be concerned about? Or do you think, it's full steam ahead no matter what?
Well, certainly following the tariff tantrum in April, the market does seem to have moved on, saying, okay, 10% tariffs, not the end of the world. We got the one big beautiful bill. We got the whole AI phenomenon, adding a lot of tailwinds. And so, yes, but the China tariff negotiations, never really concluded, right? We're on the second 90-day reprieve. And so, I guess it's a reminder that the tariffs have not completely gone away, and we still don't really even know who's paying for them, right? I mean, the sense that the exporters would bear the brunt of tariffs doesn't seem to have played out. It seems to be a very small amount, and then the majority of the cost of what basically are import taxes are borne by American consumers and importers. But again, profit margins are rising because of the AI boom when they otherwise might have been falling because of the tariff. So it's a reminder to have a nuanced view about these things, that it's never just one thing monolithically driving outcomes. It always is a mosaic approach. And here we have a number of cross currents happening at the same time.
Yeah, most definitely. Jurrien, I just wanted to highlight one more thing that the president posted in this post, which again is quite long, but he says, I was to meet President Xi in 2 weeks at APEC in South Korea, but now there seems no reason to do so. And this is something the markets had seized on as a reason for optimism, that progress was being made. Now, who knows if this is bluffing, if they are going to end up meeting in the end. But I guess as we're navigating all those cross currents, is this one more reason to maybe hedge in this market, hedge the AI boom that we've seen, and buy protection, whatever form that should take?
I mean, it's always good to have, obviously, a balanced, diversified portfolio. And it's actually a very good thing that this year, the market rally that, in the U.S. started 3 years ago next week, really has broadened to the rest of the world, not just China and emerging markets, but developed markets, Europe and Japan. So that is a pretty good hedge right there, even though they're all different equities. But, you can buy similar fundamentals in Europe and Japan now in terms of earnings growth, the growth in the payout, which is the dividends plus buybacks. That's the share of earnings that investors actually get back, and you can get all that for a fraction of the value of the valuation. And so there are ways to hedge. Obviously, bonds are a traditional way. Some cash. Gold certainly has been a very effective one as of late. But to try to time entries and exits over headlines is always a very difficult thing. We saw how bad the headlines were earlier this year, and the market, in its relentless pursuit of price discovery, read those headlines, and we fell 21%. And I think the markets are now like, okay, if it happens, then I'll react. I'm not going to react just on headlines. So who knows? Maybe this is the art of the deal. But right now, I think the market is mostly focused on earnings season, which is starting next week, and whether the acceleration in estimates that we've seen since April or May will continue to bear fruit.
Do you think that they will, Urian? Do you think that we are going to see, the banks usually kind of kick it off, or there's more banks than not in that first week? Then later we get into tech, which has been driving most of the earnings growth. Do you think, given that we continue to see stocks mostly push higher, that they're going to live up to those expectations?
My sense is that they will. The last few quarters saw a very impressive bounce. We all know this is like the oldest game in the book, right? Companies guide lower only to beat estimates, so they under promise and over deliver, I should say. And the last few quarters saw a very meaningful bounce. And right now we look at the third quarter growth estimate for third quarter S&P earnings. That growth estimate has flatlined at 7% now for several months. And typically the bounce is at least 300-400 basis points. But in recent quarters, it's been more like 500, 600, 700 basis points. So my sense is, based on revisions, based on our own internal research, that we could have another solid quarter. And that would then be the third quarter this year where you would have double-digit earnings growth. And that's exactly what this market needs, because it's not cheap, and it needs to justify its valuation by producing the earnings.
Urian, we began by talking about the analog to the 1990s from what we're seeing right now. And certainly that's been much talked about, and the idea that we could see a bubble and a bursting of the bubble. What are you seeing as you make those comparisons? And if it is a bubble, how much further it can inflate?
That is the question, of the day, of course. And yes, I do like to look at price analogs with the caveat that they work great until they no longer work. But, a few years ago when we had our bear market here in 2022, I saw the parallel with 1994, which goes back a ways, but that was Alan Greenspan raising rates, and he did so without producing a recession. So he landed the plane, and that was it's not really a bear market. The market only fell 10%, but it languished for a year, and so that we call that a stealth bear market. So that bear market turned into a roaring bull market in '95. Of course, driven by the early internet boom and helped by the fact that Greenspan gave back 3 of his rate hikes. And so there are some parallels there with 2023. Again, no recession. The bear market was entirely caused by rising rates, and then the Fed was able to give back some of those rate hikes last year and again a few weeks ago. And then the analog kind of pushes forward, and we just had that tariff tantrum in April, down 21%. And back in '98, we had long-term capital management, 22%. In both cases, the market came roaring back very, very quickly. And actually, the only other time other than this current episode that the market came back so strongly, so fast from a 20+% decline was that 1998 recovery. And guess what? Greenspan, cut rates 3 times, even though the markets had a ton of momentum. And again, you can draw the parallel to the rate cut that we just had in a market that is making new all-time highs almost every day. And with this, narrative of AI now, internet back then. So long story short, there are some similarities, which is not to say that we're in a bubble or even going to be in a bubble. Certainly, I don't see any signs that we're in one now, although there are some signs that there's some froth coming into the market. If you look at non-profitable tech stocks are flying again like they did back in 2021. So certainly the elements are there. But again, you look at the leaders, the Mag 7, their meteoric rise is basically justified by meteoric earnings. They're trading at a 35 multiple, which is higher than the market, but they're not nosebleed levels the way we saw in 1999 or 2000.
I think the non-profitable tech point is a really interesting one, Urian. If you are looking for warning signs going forward, is that one of the key things that you're going to be watching, or what would you recommend that folks pay attention to?
It's certainly one of them. I mean, I look at a host of sentiment indicators, and there really isn't a lot of sign that sentiment has really gone to extremes yet. But, the non-profitable stocks or like the retail favorites, those will give us some idea about the speculative side of things because, again, those stocks by definition don't have profits. And, just like the internet boom, you can see in the AI boom that there is room for companies to kind of make lofty promises about the next killer app, and they get a free ride, and we don't really know what's going to materialize, and that sort of is what happened a little bit in the late 90s. So it's sort of, for me, it's exhibit A right now of seeing how far investors are willing to go to kind of buy the stocks with momentum without really knowing what's going to come next or whether that will come to fruition.
Urian, it's great to see you. Thank you so much.
Thank you very much.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Well, let's get a check of the markets because things have taken a turn for the worst here. Right now, the Nasdaq bouncing off the lows, but still down 0.8%. The S&P off about 0.5%. The Dow down about 0.25%, just over 100 points. This is after a new post on Truth Social by President Trump, where he attacks China's recent move to withhold rare earth minerals from the U.S. He threatens to perhaps not meet with President Xi in South Korea as was planned. And in addition to that, he says they're potentially considering reviving some of the retaliatory tariffs that had been floated, of course, prior to the latest détente between the two nations. So that post seeming to be the catalyst for the drop that we're seeing in stocks right now. Joining me to talk more about that and more about the state of the world more broadly is Boston Consulting Group's Global Chair, Rich Lesser. Rich, we're going to talk about the reason that you were here, which is the energy transition in a moment. But I do want to ask you about this post because I know it's something you've been navigating with your clients, this sort of back and forth on tariffs. So what do you do when you see a post like this?
Look, it's been a year of very high uncertainty as it relates to tariffs. It started that way. It went even up more in the second quarter. It calmed down a bit in the third quarter. I think most business leaders, in contrast to how they felt a year ago, realized this is an area we had taken for granted with a lot of stability over decades. It hasn't been that way now. I think everybody's hope is that we'll get to a new normal, whatever that is, so that people can plan and set investment strategies. But we're not there yet, and that's going to continue. And as a result, I think CEOs are putting much more time into it personally, engaging with public sector officials and others to try to understand what's going on and where they can shape it in a positive direction. And I think they're building what we would call geopolitical muscle in their organizations. So the ability to understand the implications, figure out what the no regret moves are, both in terms of where they manufacture today, how they manage their supply chain, and really just be more prepared for a high uncertainty environment. Today is one more example of that, but it's not the first and it won't be the last.
And Rich, just quickly, I mean, surely, we've been hearing for a while that companies are not making decisions, they're not doing long-term planning because of this uncertainty, but surely they've begun to do some of that at this point. I mean, we're how many months into this? And so are we seeing some of that start to just happen regardless?
Yeah, I wouldn't have described it the way you did. I do think that was true, by the way, in the second quarter.
Right.
But I don't think that's true where we are today. Companies need to move on. You're in a new reality. What I think so I do think companies are realizing they're going to have to make some calls and have to make investments, and you don't get to control the world as it is. You have to figure out how to navigate that world in the best way possible. But we should also remember that every investment is a function of reward and risk. And I do think that trade and trade policies are an area of risk to a degree that they haven't been before. And that does put a damper on investments. It's not that people won't move forward. You just make different trade-offs when there's a different risk-reward paradigm. So the degree there's uncertainty, then I think that does slow some investments. But it's not like it's putting it to a stop. Companies need to move forward.
Rich, I'm going to take that filter and apply it to the topic that I originally wanted to talk to you about. And that's,
Sure.
The Trump administration's policies have seemingly pushed investment into the energy transition to the back burner. Of course, they've killed tax credits. They've threatened to cancel billions of dollars in grants. But we could see the private sector start to fill in where that public sector is falling away. Brookfield, for example, just raised $20 billion for its second energy transition fund. You guys just did some research on this. You came out with a big report on the energy transition. You said we are really entering a new phase. So is that what that new phase looks like, that the private sector, that they still want this and they're going to step in?
So let me just start by saying the focus of our report was global, not just the U.S. And I want to be clear about that because, policies have now really diverged around the world. And so you have to step back and look at that. And we came out with 7 observations that I think still stand. One is clearly the growth of energy security is substantial, that we really are focused in a world of energy security to a much higher degree than we were when we wrote our first report on this a couple of years ago. Second, energy prices are having a major implication on sustaining public support. And that's very clear in the US, but it's not just the US thing. Third, electricity has entered a super cycle. And demand is going up, certainly in the US, driven by data centers, but in other parts of the world, often driven by cooling requirements, industrialization in places like India and China. And so electricity is growing dramatically. Fourth, natural gas and nuclear are back in the plans in a big way. And when you put all that together, we've gone from a world where everybody, particularly as it related to infrastructure, electricity infrastructure and the like, the focus was get the most out of the assets you already had. And now we're much more in a world of build assets. We've got to build assets in this system. And that hasn't been done for a long time in many places. So, and to take the US as an example, relative to the first wave of the electrification of the country, the same amount of infrastructure adjusted for inflation is 6 times more expensive to build, between permittings and delays and labor costs and now the cost of the assets themselves. Electricity infrastructure is getting more expensive. That's a very challenging thing. Oil and gas is higher than we expected a few years ago, but also highly uncertain. And as it relates to decarbonization technology, we're really seeing costs diverging. Some technologies, solar, wind, batteries, are continuing to drop dramatically in costs. Others, like hydrogen or some others, have actually turned out to be more expensive than we were projecting. So that's the backdrop that we're living in right now. And it's a different backdrop than 2 years ago. And part of it is the divergence in policy around the world.
And part of it, as you say, is because of, sort of increased costs in many cases too. So, Rich, where does that leave us? It doesn't paint a very sort of encouraging picture when it comes to furthering the transition.
So let me be direct on both sides of it. You are completely right that, we are off track in terms of the original projections of the Paris Agreement or whatever you want to talk about. We are going to be well above a 1.5 degree temperature increase, probably on the trajectory of 2.5 to 3 degrees. That doesn't mean we shouldn't try to change it. 2.5 is better than 2.7, 2.2 is better than 2.5. So it doesn't mean we don't continue to try to make progress, but it would be unrealistic to pretend we're on track for what the original hopes were in terms of controlling rises in temperatures. The second thing is these markets are continuing to grow substantially. So we're just coming out with some work that we've been doing over the last few months that if you look at the combination of mitigation and adaptation, it's about a $5 trillion market today globally, on track to be a $7 trillion market by 2030. About 80% of that sits in mitigation. About 20% of that sits in adaptation and resilience. These are very, very large global markets. What most businesses are realizing is you need to make sure that your logic around sustainability is aligned with your logic around building and strengthening your business. Most businesses want to head toward markets that have tailwinds around them, and that will make a lot of sense. But that pressure to focus on the business element around this as you set policies around sustainability is really important. These are large and growing markets.
So, Rich, finally, is this what you're hearing from your clients, that they've invested in these markets already, they've invested in the transition, and they are still motivated to stay the course?
If you said on average, yes, that's probably right. But I want to highlight a couple things. One is different technologies, because their cost profiles are different, depend on government policies to different degrees. And so if your business is in a technology where the costs aren't coming down as quick, where you depend on policy, then obviously the kind of changes in policy we've seen in the US, but in some other places too, are going to meaningfully impact how you think about investment. And if you're in other places where the technology's economics stand alone pretty well, then government policies are less a driver, and you realize, and these costs will likely continue to go down, and therefore it would be foolish to walk away from them, and they're likely growing faster than your core business, and you want to stick around. So it's very hard to put a one-size-fits-all answer on this, because the market dynamics are different, policy dynamics are different, and the relative costs of more sustainable technologies really differ across technology class.
Rich, great to see you. Thank you so much for joining us.
Great to see you, Julie. Sure, pleasure.
We'll have a check on the markets coming up as we see things turn towards the negative. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke DePalma, live at the NASDAQ here in Times Square. Let's get a quick check on the latest market action. We're about 2 hours into the trading session today, and we've seen all three major indices now reverse into the red after President Trump took to Truth Social saying, quote, very strange things are happening in China. He went on to say that one of the policies that they're calculating at this moment is a massive increase of tariffs on Chinese products coming into the U.S. This is, of course, a change. He also said that he does not plan to meet with President Xi in the next few weeks like we had expected. And you could see markets really reacting to this, led lower by the NASDAQ down about 1.9%, and the S&P 500 also falling lower as well. And this has really been a week where investors are trying to make sense of this government shutdown, policy uncertainty now even more so, and ahead of that key Q3 report. But I do want to go to the NASDAQ because we are seeing some of the laggards there really leading the momentum down. Amazon, AMD, Micron, Qualcomm, some of those, really big chip makers, NVIDIA also feeling downward momentum, downward pressure this morning, down about 2% now after it saw a hype up this week after that deal that was also announced to open AI. I also want to take a look at China stocks as well, because what we're seeing in China stocks is really the most downward momentum. Alibaba seeing a huge decline this morning, down about 6%. So seeing that stock slide this morning after really this year has seen a tremendous run up, more than 90%. Now to see this downward pressure is not something we've seen in quite some time. I also want to hit Baidu. It's a company that has seen momentum as well, especially around those those robo-taxis. That stock up more than 47%. And now today, we're seeing this sharp decline after this announcement from President Trump. So you can see right here, all China-related stocks in the red right now after we did get this announcement, or rather this Truth Social post from President Trump that they do plan to implement massive tariffs on China as of now. But keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout the trading session.
As we just heard, U.S. stocks falling after a social post from Truth Social post from President Trump moments ago. The most pertinent part of this is that he is attacking China for its most recent curbs on the export of rare earth minerals to other countries, particularly to the United States. And he is threatening, among other things, what he calls a massive increase of tariffs on Chinese products coming into the United States of America. He says there are many other countermeasures that are likewise under serious consideration. He says he also might not meet now with President Xi of China, as was planned, in a few weeks' time. Let's talk more about this. Joining me now is Darius Dale, 42 Macro founder and CEO. Darius, so we haven't gotten one of these in a while, right? Yep. Sort of the more strong language post from President Trump about China. And the market has really gotten used to the idea of tariffs.
Oh, yeah.
Is this just, posturing? What do you think?
Thanks for having me. I'm going to tell you guys and the fine viewers of Yahoo Finance the same thing we've been coaching our global investor community on since we turned bullish in April, which is to put earmuffs on whenever you hear the word tariffs. This is an administration that understands that it has to outgrow the debt and deficit trajectory. And in our view, they're pulling many levers both in front of us and behind the scenes to create a durable and robust recovery in the economy starting in next year. And so anything we see with regards to tariffs and obviously today's Truth Social post catalyzing the downturn in markets today, in our view, it's a buying opportunity.
Why isn't it a bigger problem? Or do you just think that the president's not going to go through with this? Do you think even if he does, it's still in service of catalyzing that growth that you're talking about? Yeah,
that's a great question. And in our view, we think the net impact of the fiscal, regulatory, trade policy, monetary policy changes that the administration is enacting, with the biggest being the likely structural regime change we're going to see at the Federal Reserve in the coming 1 to 2 years. We think that the net mix of that is likely to create a robust and durable recovery in the economy. And so if we focus myopically on one of those aspects, then we're ultimately going to miss the big picture. Tariffs are the trees. What we've been saying is paradigm C is the forest.
Something really interesting that you just said as you were listing the changes the administration is making, you put monetary policy under there.
Absolutely.
Monetary policy usually doesn't go under the administration bucket, Darius.
No, it does not.
Do you think it should?
That's not for me to opine on.
Okay.
It's for me to make money on and help our global investor community make money.
And so whether we like it or not, it looks like that's what's happening, in other words. And so what does that imply then for that piece of the stimulus that you're talking about?
Well, it's very likely that the next Fed chair comes in and creates a very robust discussion around what the level of the neutral policy rate should be. In our opinion, we think it's likely to be much lower, as obviously evidenced by the signaling that we receive from the administration. And we would actually support that. Our research and our models have consistently shown that this is an economy experiencing fiscal dominance from a fiscal policy perspective, but it's not necessarily getting the monetary support that would offset the distributional impact on the negative distributional impacts on the economy from the fiscal dominance. And so it's a necessary precondition of this sustained fiscal dominance regime is monetary support. Financial repression, monetary debasement. And in our view, those things are going to come regardless of how we get there. In our opinion, they're accelerating the get there part.
Does that mean we don't worry about the dual mandate anymore? It's more about those sort of structural supports?
Well, so again, one of the things we've coached our investor community to pay attention to is that the policy dynamic and the discourse around policy in this country is shifting from what had been, focus on aggregate economic statistics, GDP, corporate profits, stock market, to distributional statistics. I mean, you go back and you look at the hue of the electoral college map from last fall, that should tell you everything you need to know about the sense of urgency up on boots on the ground with regards to consumers and businesses, the small businesses that have been left behind, the households that have been left behind in this economy. I mean, I'll throw a couple statistics at you. One, we have negative job growth in non-government and government adjacent sectors in the economy. Over the last 3 years, I would say somewhere around 20%, only 20% of jobs have come from the private sector over the last 3 years.
What has happened thus far this year, though, has not helped those households or those small businesses.
Agreed.
So what changes in the next year?
Yeah, on the positive side of the ledger, we have a significant fiscal easing that's likely to come down the pike starting in 26 and 27, right about $400 billion of incremental deficit expansion in 26, right around $500 to $600 billion in 27. And so that's our models are pointing to those numbers. So that's one. On the deregulation side, we're already starting to see a cyclical upturn in credit growth. We're back to a trend level of credit growth after being hundreds of basis points below trend for multiple years. And so we're starting to see the deregulation both within and external from the financial sector really start to impact the economy. And the third leg of that stool, the positive side of the stool, is the structural regime change we're likely to see at the Federal Reserve next year.
What could go wrong?
What could go wrong? Well, if they start kicking over the legs of the stool, or if they overweight the tariff piece. It's our view that their goal is to outgrow the debt and deficit trajectory. And so if that's your goal, work backwards from there. And so ultimately the net of all this policy change is likely to be positive. And this is why we've been so bullish all year.
I want to mention the University of Michigan preliminary consumer confidence numbers we got today. They came in at 55, which is a little bit better than estimated, but still low, and I think the lowest in something like 9 months. People are not feeling good out there. They're not seeing this trajectory that you're talking about. What do you think is going on here and is there a possibility that we won't get there and that those folks who are in the bottom half are not going to accrue these benefits you're talking about?
Well, as someone who grew up at the very bottom of the bottom half, I'll tell you, by the time we feel good, it'll be too late to make money in markets. And that's always been true, unfortunately. And so the reality is we just have, as investors, we have to skate to where the puck is going. And the puck is going to the other side of this U-shaped economy our models have been guiding our clients to all year. We're in the nadir of the U-shaped economy, so of course the economic data looks bad, the labor market looks bad, the Fed is now implementing rate cuts again. But the other side of the U, as a function of all those changes we just highlighted, is likely to be a robust and durable recovery that markets are still not fully priced in.
Darius, thanks for coming in.
Thanks, Julie. Appreciate you.
Coming up, 3 years out from the 2022 bear market bottom. Jared's going to have more next.
Well, consumers are already largely reporting an increase in spending over the past 3 months, according to a new KeyBank consumer survey. And as the holiday season approaches, early holiday spending expectations are looking encouraging. Here with a closer look is KeyBank Capital Markets Managing Director and Equity Research Analyst Brad Thomas. Brad, it's great to see you. So let's dive right into this. So start with financial confidence for respondents. Per your survey, Brad, this was interesting. Improving to the highest level since Q2 2021. A few questions there. When we talk about financial confidence, Brad, how are we defining that, and what explains that trend?
So that metric has to do with the outlook for the consumer, for their ability to spend and provide for themselves and their family. And it was really encouraging the data that we saw. We think that that's mostly tied to the stock market being near or at all-time highs at the time that this survey was conducted a few weeks ago, as well as optimism around the Fed rate cuts and benefits from the One Big Beautiful Bill. And it's important to remember, of course, that the top 10% of Americans account for about 50% of spending. So that wealth effect really hopefully ends up being a nice halo for us going into this holiday season in 2026.
And then, Brad, that's confidence. The spending was interesting too. 47% indicating expectations to increase spending compared to the prior year. Explain that for us, Brad. What explains that trend? And I'm also curious, what are they intending to spend on? Is it what they want? Is it what they need? Is it a mix?
That's right. We were really encouraged with that result. 47% of our respondents in this quarterly survey that we've been doing going back to 2017 saying they expected to spend more this holiday season. That's the strongest number in 3 years and follows very favorable results on the question, did you increase your back to school spending, of which 44% said that they spent more this year. And that's usually a very important indicator of how holiday sales will be. So I think some nice momentum and some nice intentions to spend as we look forward to these all-important months of November and December, and to some extent October here with some of these early Black Friday sales kicking off. What are they spending on, you asked? We're seeing a little bit of improvement in some of the discretionary categories, the home-related categories, for example, consumer electronics, which had been weak over the last 3 to 4 years coming out of the pandemic. So that's a really encouraging secular trend that we think is underway, in addition to some of the more broad confidence we're seeing from the consumer right now.
There are concerns, Brad, as you know, about this cooling labor market. I'm curious to know, if it keeps cooling, Brad, what could that potentially mean for what we're talking about here, for consumer confidence and consumer spending?
It's a great question, and I want to be clear, there's no question there are a number of cross currents on the consumer right now, and a labor market that's a little bit softer is one of them. I think the good news is that the labor trends tend to be a bit more of a lagging indicator, and the leading indicators, such as the wealth effect, the monetary stimulus, the fiscal stimulus, we think that those point in the right direction and will underscore consumer confidence, going into this holiday season.
There are different kinds of consumers, of course, Brad, higher income, middle, lower. What were the differences your survey was picking up there?
There's certainly some bifurcation. When you cut the data, it's interesting. It was the age demographic of 30 to 44 that seemed to have 30 to 44 that seemed to have the greatest improvement in confidence over the last couple of quarters. And it shouldn't come as a surprise to us that those are folks that probably have more exposure to the stock market and some of the benefits of the one big beautiful bill from a personal finance standpoint. As we look forward here, in terms of the demographics, there's also some challenges that are coming up at the low end of the market. No question, the inflation will nip away a little bit more at their spending power. They were probably under a little bit more pressure from some of the softer labor trends that we've seen of late. And where we're seeing that show up in our consumer survey is an increased likelihood to shop at the dollar stores. When we ask the question, which dollar stores have you shopped at? The likelihood to check those boxes has been going up for a couple of quarters now. And we think that bodes well for some of the trade down trends within the dollar store space.
So to add it up here for investors who are watching, Brad, to get to some names you all like, it looks like you prefer, I see Walmart, I see Ollie's, I see Lowe's. Are there common themes and threads among those picks, Brad?
There are, and thank you for asking. There's two sort of buckets that we like to think about our top ideas as falling in. The first is sort of the all-weather bucket, that are names that we think have company-specific tailwinds that are going to drive market share gains and an ability to perform in good consumer times and challenging consumer times. And we would put Walmart in that bucket, Ollie's Bargain Outlet, that's a closeout retailer that's benefiting from the pressure that's being put on many of the retailers that you're seeing go out of business. A lot of that leads to inventory at Ollie's, where the consumer can save money. And then we'd also name Casey's General Store to that group. Casey's is a convenience store, a gas station that has a wonderful pizza offering. And they've had a lot of innovation on the food side, growth in rural markets that we think positions them very well. Our second bucket is the more discretionary side of things, and it skews a bit more home related. And we're hopeful that this group benefits from stabilization, hopefully growth in housing and home related spending as we move into 2026. And our favorite names as we think about that side of our coverage list would be Somni Group. This used to be called Tempur Sealy, but they bought Mattress Firm. Now it's the ticker's SGI, Somni Group. Lowe's in the home improvement space that has a lower valuation than Home Depot is why we prefer it to Home Depot. And finally, Williams-Sonoma. Those would be the three that we think have the best exposure on the discretionary side of things, more so as we look out to 2026.
Brad, appreciate your time and those picks. Thank you.
Thank you.
3 years ago, the 2022 bear market bottomed. And as year 4 of this bull market kicks off, investors want to know how much room we have to run. And that's what we're focusing on in today's Stocks in Translation. This first chart here is courtesy of Keith Lerner over at Truist, and is showing every third year of a bull market since 1957. Notice the far right. The current year, year 3, is the strongest of the bunch. So now we've got momentum, but how long do these bull markets typically last? Well, zooming out almost a century, here are the S&P 500 returns for all the 15 bull markets since 1932, including the current one. The bar at the far right is the average of the prior 14, which is almost double the current return of over 85% in the S&P 500. On average, bulls last about 5 years, 2 years longer than the current one. So at least according to history, this is not an old bull market just yet, and there's more theoretical room to run. Now let's see who did the heavy lifting. And for that, we're going to first turn to the S&P 500 sectors. This is going back 3 years, and you can see XLK here is up 139.5%. That is the leader. And if we take a look over the last 3 years, you can see a few hiccups and some sideways action here. And by the way, that's when NVIDIA was also going sideways, but it has really rocketed recently. Number 2, that's communication services. That has Alphabet, and it also has Meta. Then we have industrials, financials, each up more than 70. And then XLY is consumer discretionary, bunch of retail names with Amazon and Tesla at the lead. Now, if we drill this down to 1 year, you can see a little bit of red. But aside from materials, XLB there, all the red ones are defensive, so this is still bullish in nature. Number 1, that's communication services with 26.8%, and then tech, and then consumer discretionary. Those are the mega cap sectors, so there are concerns of concentration right now. Even number 4, XLU, that's utilities, up 15.6%. Well, that's kind of an AI derivative play right now. So let's check out the NASDAQ 100. And here we can see in the upper left there's good old NVIDIA, $4 trillion stock, up 40% over the last year. But I'm going to change that to a 3-year look where it rockets higher to 1,523% and change as we're talking here. Here's a quick chart, and you can see there's that sideways action that we were seeing in tech that also corresponded with NVIDIA taking a pause, but again, rocketing higher very recently. But guess what? Palantir up 2,150%, that tops it. And you can see this has just really rocketed up mostly over the last year. We had a lot of green on this chart and not a lot of red. So let me just skip over to some of our leaders, where in the upper left, when we take a look at some of these sentiment ETFs, GBTC, that's my Bitcoin proxy, up over 800% over these last 3 years. In second place, we got the chip stocks at 166%, then MEG 7 ETF, then ARK Innovation Fund, then we got software, the Qs, that's basically the NASDAQ 100, an internet ETF, and ITA. ITA is interesting because this was a really good defensive play when we had the post-Liberation Day sell-off. It didn't fall off as much as everyone else, and it's probably still a pretty good diversifier. So putting it all together, we got some good options here. We've had a lot of bullishness, but let's take a look at what to look for in the coming weeks and months as we head into the 4th year of this bull market. So as earnings from big tech come rolling in over the coming weeks, you want to pay attention to the AI leaders, which are currently priced for perfection, as the street says. Any misses, especially on future guidance, that could bite. Then we want to watch out for sector rotation on any pullbacks in tech. Rotation is the lifeblood of bull markets, as they say, and we want to see investors move into other areas besides tech to keep this bull market alive. Then you got to watch gold flows. According to the work of Todd Sohn at Strategas ETF Research, the 1-year flows in gold ETFs have just reached the same level in 2020 that occurred just as the price of gold was topping and starting to turn down. Now, history doesn't have to repeat, but gold ETF flows are red hot. And if the trend reverses, that could hit the price of the yellow metal as well. And now that Bitcoin is back to record highs, watch the crypto bid. Bitcoin is famous for reversing short term after hitting new highs, and a dip below 120,000 would be an orange flag for risk sentiment in general. Finally, meme stocks are surging, albeit for different reasons in 2021. But it's incredibly interesting that Roundhill just relaunched their meme ETF a few days ago. And when they first launched their meme ETF in late 2021, that essentially top-ticked the initial pandemic bull market, and it was the start of the 2022 bear. So putting it all together, this is not an old bull market by historical standards, but it is very speculative lately. Earnings will set the tone soon, so stay alert. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts up next.
Etsy set to begin trading on the New York Stock Exchange next week, moving its listing from the NASDAQ. Investors initially viewed the news favorably, with the stock hitting a new record high when the move was first announced. A company's choice of stock exchange could have a big financial impact, and there are many reasons why a company might move its listing. First, a company might be looking for better visibility. A larger exchange could help attract more investors and boost the company's credibility. Another reason for switching could be that a company is looking for lower listing fees. The NYSE typically has higher listing fees than the NASDAQ. The NASDAQ's lower fee structure is usually beneficial to startups, while the NYSE attracts more established companies that are less concerned with the fees. Finally, a company could also be looking for a more favorable regulatory environment when switching listings. Both the NYSE and the NASDAQ have initial listing requirements that a company must meet to be listed and continued standards to remain listed. A company can even be delisted if it no longer meets those requirements. One thing to keep in mind, a change of exchange won't really affect investors who own the stock. Shareholders could see changes in trading volume, but the actual ownership and number of shares held by existing shareholders will not change. And one quick precision there, Etsy wasn't a record. It was, I believe, a 52-week high, but something to keep in mind. And that does it for our Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance coming up.